What is carry in private equity? In private equity, there's a term that gets a lot of attention, carry. It's short for carried interest. It's the magic word that can turn investment managers into multimillionaires and a subject of intense debate in financial circles. It's also at the heart of how private equity firms make their money. But what exactly is carry, and why is it so important in private equity? Today we're diving deep into this crucial concept. Hi everyone, welcome back to the channel. Now, whether you're an aspiring investment professional, a curious investor, or just someone trying to understand how the financial world works, this video is for you. So let's jump in and demystify one of private equity's most important concepts. First things first, what exactly is carry? Carry, short for carried interest, is essentially a share of the profits that private equity firms earn from their investments. It's a performance fee, a way for these firms to reward themselves for generating returns above a certain threshold. But carry isn't just any old bonus. It's a significant portion of a private equity firm's compensation, often making up the lion's share of the payouts to top executives and investment professionals. To understand carry, we need to take a quick step back and look at how private equity firms operate. Now, private equity firms raise money from investors, thinking like pension funds, endowments, and wealthy individuals. They pool this money into a fund and use it to buy companies. The goal is to improve these companies over a few years and then sell them for a profit. Now, private equity firms make money in two main ways. First of all, management fees. It's typically about 2% of the assets they manage, charged annually. It's meant to cover the firm's operating expenses. And then carried interest, the topic of our conversation. This is where the real money is made. It's usually 20% of the profits above a certain return threshold. This structure is often referred to as a 2 and 20, or a 2% management fee and 20% carry. Think of it like this. Imagine you're really good at finding undervalued houses. You fix them up, and then you sell them on for a profit. You team up with some friends who have money to invest, but they don't have your expertise. You agree that you'll do all the work of finding, renovating, and selling the houses, and in return, you'll get 20% of any profits above a certain level. That 20% is essentially your carried interest. Now let's break down how carry works in practice with a simplified example. Let's say a private equity firm raises $1 billion for a fund. They use this money to buy, improve, and sell companies over a period of 10 years. Let's assume they've turned that $1 billion into $3 billion at the end of those 10 years. That's a $2 billion profit. But before anyone starts celebrating, there's an important concept to understand: the hurdle rate. The hurdle rate, also known as the preferred return, is a minimum return that the private equity firm must achieve before they can start earning carry. It's typically around 8% per year. This is to ensure that the investors, also called LPs or limited partners, get a decent return on their investment before the private equity firm starts taking a cut of the profits. In our example, let's say the hurdle rate is 8% per year. So over 10 years, that amounts to about $1.16 billion. So the first $1.16 billion in profits goes entirely to the investors to meet the hurdle rate. That leaves $840 million in profits above the hurdle rate. This is where the carry comes in. The private equity firm gets 20% of this amount as carried interest, which in this case is $168 million. The remaining 80% of the profits above the hurdle rate, $672 million, goes to the investors, along with their initial $1 billion investment and the $1.16 billion hurdle rate. So, to sum it up, investors get $2.832 billion, $1 billion initial, plus $1.16 billion hurdle, plus $672 million, 80% of excess. Private equity firm gets $168 million in carry. Now, you might be thinking, it doesn't sound like a lot for the private equity firm. But remember, this is on top of the management fees they've been collecting all along. 2% of $1 billion per year for 10 years is another $200 million. Plus, the firm's partners often invest their own money alongside the fund, so they're gaining a share of the investors' returns as well. But here's where it gets controversial. Carried interest is typically taxed as capital gains rather than ordinary income. In many countries, including the United States, the capital gains tax rate is significantly lower than the rate for ordinary income. That means that private equity partners often pay a lower tax rate on their carried interest than they would on a regular salary. The tax treatment has been a subject of intense debate. Supporters argue that carry is a form of investment income and should be taxed as such. They say it incentivizes private equity firms to generate strong returns, which benefits the economy as a whole. Now, on the other hand, critics argue that carry is effectively a performance fee for services rendered and should be taxed as ordinary income. They contend that the current system allows already wealthy private equity partners to pay less in taxes than many middle-class workers. Now look, this debate has led to numerous attempts to change the tax treatment of carried interest, but so far the basic structure remains in place in most jurisdictions. Now, let's delve a little bit deeper into some of the nuances of carry. First, it's important to understand that carry isn't guaranteed. If a fund doesn't generate returns above the hurdle rate, the private equity firm doesn't earn any carry. This aligns the firm's interests with those of its investors. The firm only succeeds if its investors do very, very well. Second, the timing of carry payments can be complex. While we've discussed carry as if it's paid out at the end of the fund's life, in reality it's often paid out as investments are sold. However, there's usually a clawback provision. This means that if losses follow early successes, the private equity firm might have to pay back some of the carry they received. Third, not everyone at a private equity firm gets an equal share of the carry. It's typically heavily weighted towards the senior partners, with more junior staff receiving smaller percentages. This carry allocation is often a key part of compensation negotiations within private equity firms. Fourth, some funds use a European waterfall structure for distributing profits, while others use an American waterfall. All capital must be returned to investors in a European waterfall before any carry is paid. In an American waterfall, carry can be paid out on a deal-by-deal basis. Now, this can significantly affect when private equity professionals receive their carry payments. And lastly, it's worth noting that while we've been discussing carry in the context of private equity, similar structures exist in venture capital, real estate funds, and other alternative investments. So there you have it. That's carry in private equity. It's a powerful incentive mechanism that aligns the interests of investors and fund managers, but also a source of controversy due to its tax treatment. Understanding carry is crucial for anyone looking to work in private equity. It's a major part of the compensation structure and can make a huge difference in earnings over a career. For investors in private equity funds, understanding carry is important for assessing the alignment of interest with the fund managers and understanding the full cost structure of their investment. For policymakers and those interested in financial regulation, the debate over how carry should be taxed remains very hot. It's a hot topic. Carry in private equity remains the performance fee that can turn good investors into multi-millionaires. It aligns interests, motivates performance, and attracts talent. But it's also complex, potentially risky, and not without its controversy. As we've seen, carry is more than just a footnote in private equity compensation. It's a key driver of behavior in the industry, influencing everything from investment decisions to talent acquisition and retention. Now, whether you see it as a fair reward for performance or as a tax loophole that needs closing, one thing's for sure, carry will continue to be a critical concept in the world of private equity for years to come. Covered a lot of ground today, as we always do, and I want to hear from you. What are your thoughts on carried interest? Do you think it's a fair way to compensate private equity professionals, or does the system need reforming? I don't know, drop a comment below and tell me about it. Give me your input. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more insights on private equity, venture capital, and finance. Don't forget to hit that notification bell so you never miss an upload. So until next time, keep learning and happy investing.